Volatility is typically used as a proxy for risk with certain investments, where investment advisors will say, hey, if that asset, that stock is more volatile than a different one, then it's going to be more risky for you. That's a terrible way to assess risk, by the way, but that's a story for another time. But volatility in the markets is calculated a different way. The most common way to assess volatility is by looking at the volatility index, which shows the volatility of the S&P 500. This is also commonly called the VIX. The way this index is calculated is by looking at the pricing of at-the-money options on the underlying index, which in this case is the S&P 500. When at-the-money calls and puts are higher priced than they used to be, then the market is pricing in a higher chance of volatility because buyers of those options are willing to pay more for the likelihood or for the chance that the index will move one way or the other. And so the pricing of these at-the-money options is reflected in the value of the index.